Now we're going to turn to bank lending. What are some of the changes that we've seen in lending standards? How is the consumer shaping up when we start looking at their lending? And then we're going to talk about ISM and some of the implications within those numbers, as we've talked about the top line numbers already. So when we turn to liabilities and capitalization, so let's look at reserve balance sheets. Draining reserve balances with Federal Reserve. This is where we're seeing some of those drawdowns when we're considering what is going into the reverse repo. We've seen a lot of that come out of the market, and this is what is being shifted in general when we look at liabilities and capital. Because remember, those liabilities that we've talked about, they become liabilities. There's capital transfers that happen within them. And then this is, I think, a key component as to where things have gone. What is that spike? You can see the increase in liquidity that came into the market. That happened in March. Saw that acceleration. Now you're starting to see that come back out. But it's just more of that managing side when you look at the reverse repos that we talked about previously. But it's important to layer that in with what are the opportunity costs and what are some of the things that banks can do with that capital. So when we look at loan to deposit ratio, this is what we were talking about, where if you give a bank $100, they want to invest, let's call it, $80 to $90 of that 100. You can see obviously when leverage came into play, you can see that they were actually lending way more than that. But that has since, they've tried to adjust that. But when you look at just what the lending ratios are, you can see how it's come down a significant amount. So small banks are only able to lend about 75 cents of every dollar, or $75 of 100. And when you look at large banks, they're closer to almost 50 cents or $50 per 100. So it's a mixture of not enough opportunity because of rates, because they're just not getting a rate of return. It's also just there's a huge surge of transfers. So there's a mixture between the two that is essentially creating some of that backdrop. So those are some of those overhangs that it points to, why are we still buying $120 billion a month? Like, they can't do anything with that money anyway, and they've already been struggling since 2016, which is why when you look at what were we really providing liquidity for? And that's when you start looking at prime brokers and hedge funds and guys that were levered long, because it was really that side that needed the liquidity, not so much those large banks. And that's where you start to see this pressure that has mounted, which is why we think that there's going to have to be a cut to these purchases. So then let's look at margin debt, because where is margin debt right now? Because margin rates are so low, margin debt is moving to that high. Why not? Because why wouldn't you? The debt is near free. Why not just borrow it and then try to blast it into the market? So this is margin debt as a percentage of SPX. Market cap is lower than at any point, but the margin debt as an actual dollars in millions is the biggest key right now, because that is where we continue to have people that are averaging down, levering up, and have the biggest exposure. And especially when you think about options and futures, because they're relying more and more on some of these more esoteric products that they haven't used previously, which can also skew what that margin debt as a percentage of SPX. Because why buy equities? So why buy 100 equities, stocks, where I can buy 10 options? Or why am I going? I can get more leverage in one versus the other. So that's where you start to see some of this disconnect in general when you're looking at the multiplier effect, and just again you're buying a delta. So when you're buying an at the money option, you're really buying half the position, because on the delta side, and not to get too complicated, but when you're buying a stock, you're buying one share. When you're buying one option, you're really buying half the position, because you're buying 0.5 of the underlying stock in general. And that's where we see the pressure points, because when you get the leverage payout, but you also get that loss. Now, the loss isn't as bad as long as you're selling, as long as you're buying options and not selling them. And that's where some of those percentages come in. And as you go further into the money, that delta starts to trade just like stock, where you go from 0.5 to 1. And then you'll start to see that. And that's where you get, but if you're wrong, well, and you're buying at the money's weeklies, that goes away very quickly. And that's where you can start to see people get into trouble as they're doing it on margin. And as that whittles away, you can actually go below zero and actually owe money into the system. So then when we look at, okay, well, how are mortgage rates going and what is that actually going through? Well, when we look at the HPA, which is just the home price appreciation, this is what they're expecting. When you look at the AEI, I highly recommend signing up. It's just a blog that gets sent to your email, and they always have some really good insights. This is where, and they've been spot on, to be fair, this is the expectation going through August, because even though people are rejecting prices in housing, they're balking where they're like, that seems high, but they're eventually paying up. And that's where we're seeing some of that disconnect, where some things have slowed in the housing side, but eventually they essentially say, well, I guess we have to anyway. And that's where we continue to see some of this appreciation. And you're getting banks that are lending because, they have all this cash. They have nowhere to put it. So what are they doing? Well, lending standards. Well, consumer credit. Consumer credit is getting easier. You had this insane tightening, and now they're just getting we're at an easiest point in a long time. And when you look at U.S. May consumer credit, it rose to $35.28 billion, which is up $18 billion. So consumer credit in May rose 10% at an annual rate to $4.279 trillion. Revolving credit, non-revolving credit, all of them are up. And it's because the standards are getting easier, which is just making it a much easier sell and getting it into the market in general. Because again, I'm either going to give it to the Fed at 5 basis points, or I can lend it to you as a credit card at 10%. I mean, it's a little bit easier to come up with some of the reasons. And if you're assuming that they're going to be fairly liquid, it becomes a little bit easier in general. Now, subprime lending standards have actually started to increase. But when you look at non-GSE, GSE eligible, their standards are getting easier again, almost extensively easier. Even before, on pre-COVID levels, they're easier. So again, it's just this need to get this capital into the market and using something that at least has a collateral base to go against, that you can feel better, where it's like, okay, well, at least I won't lose everything. I'll be able to gain something in terms of, what happens if they go bankrupt, or if something happens, and what does it mean in terms of my overall risk. And I think that is, a bigger side of the equation that is missing, is because a bank wants to lend, but they also want to get a rate of return, but they also want a certain amount of safety. And that asset is obviously the house, which provides that exponential amount of safety. But now we're starting to see houses not appraised. You're starting to get a little bit of pressure when you look at the appraisal side. And what does that mean in terms of, well, what kind of level? Like what pressure will that be over time? So here we'll go into excuse me. When we look at the backdrop between small bank lending and the residential and commercial, so small banks account for virtually all new real estate lending. So it comes to, where are they going to get some of this return and safety? And again, that comes to, well, let's go into the housing market where we feel a bit more comfortable with our exposure. But then when you look at some of that peak that we've seen in general, June ISM manufacturing went to 60.6 versus 60.9 estimate. Continuing, it's still elevated, but again, moving lower. But the prices paid up to 92.1, highest since 1979. Inflationary pressures, but then when you look at employment, that came back into the contractionary level. And then when you look at the contribution, ISM services in general remained to be the continue to come back, but it's less about employment and it's more about, because it's actually slight negative, supplier deliveries continue to be the overarching problem, which even though it provides a positive bump to ISM, it's actually a negative contributor, which is where we get some of the disconnect on what are the internals and why the internals are so important. So when we look at prices paid, this is just showing the survey was for 87 up to 92.1, again, surging to an all-time high, taking out even the high of 2008. And then when we look at ISM, the backlog of orders have started to come down. Supplier deliveries have started to normalize a bit. And a lot of that is you're starting to see some customer inventories. We're starting to see some balancing, not extreme, but some balancing in terms of some of this pressure, which is why the renewed issues on the supply chain in terms of shipping are an unwelcome situation given where we thought we were going to be and how things were starting to stabilize. And then when you look at prices, PMI service prices up at 80, backlog of orders all-time high, but inventory sentiment continues to move to an all-time low, because you're still seeing where some of the data is getting a little bit better, but you can see it's just stopped going up, but it hasn't really come down. It's just pausing at this point as you see some of these pressures come in. And again, this is the next big level of inflation and some of this pricing that's going to come through as rising cost. But it's what is happening with some of these, like the zombie debt. So back in the beginning of not only 2020, but also in the beginning of 2021, we highlighted the zombie debt, which is just a company that needs debt to survive, and firms are sitting on unprecedented $2 trillion of obligations. So this is one of those things that as rates go up, this gets blown out, because then it becomes harder and harder to finance your business, because you constantly are trying to roll, trying to re-rate, trying to survive, and you're only using it on debt because you don't have the revenue or really the business model to survive at that period in time. It could be because you're early, you're a growth stock. What is the avenue to cash generation? And this is something that is only grown as free money has grown as well. So then when you look at the pandemic and private equity firms, so private equity firms are continuing to bid up items. And this is what we've talked about in previous periods, where when you look at private equity purchases, where if they maintain this base, it's going to be at the highest level ever. And when you look at LBOs are back in fashion, which are just leveraged buyouts. You're seeing leveraged buyouts come back in this, where we're back to 2007 levels, where we have these massive LBOs because cash is cheap, debt is cheap, so lever up and buy something. And that's where, based on the pressure right now, and if you look at real estate, some of those investments are coming down, but when you look at what private equity and VCs are investing in, there's a lot of startups, there's a lot of second, third rounds that are coming in on the fintech side, healthcare tech side, a lot of the tech and growth components, and you're seeing a lot of these bids go up in general. Now, just rounding it out, looking at the consumer, when you look at the daily net purchases of U.S. equities by individual investors, this just gives you an idea of just how active the individual investor really is when we look at U.S. equities, and when we look at just how much is actually going into when an investor buys not only just an option and then the underlying that has to be hedged, but it just shows just the amount of leverage that's in the system and the problems if we have a bigger correction, not even a huge one. I'm just talking about a minor correction, or a correction where buying the dip fails. And it's not that, how many people panic, how many margin calls are there, and then that could get a bit more of that panic selling, which could become additional pressure. So these are the things to watch. But now enough about the US. We get to talk about Europe and then finally wrap up with Asia.